Now, this presentation, what we're going to do to kick off the event for y'all is 5 slides about the national economy, things that are on your mind, they're on all our minds. We're going to give 6 slides locally, kind of an outsider's view, looking in at our local real estate markets to get the panelists, give you some things to think about as an outsider. Then we're going to give you 2 market slides that you might find of interest. So 13 slides total. We'll get through them as quick as we can. If you're not familiar with Huntington, this is Huntington's footprint now. Chicago, we're about in the middle of that footprint now because we grew northwest last year. Acquisition of TCF Bank. We're very glad to have those colleagues, very glad to have all the Huntington colleagues in the room today. 5 slides on the national economy. First off, when we look at national economies, we look at 5 items. And again, Marianne has these slides if you find them of interest. If you look down the right-hand side, we call these 5 building blocks. So in our country, consumer spending is about 70%. Very important. Consumers, you and I, doing very well spending. No issues there. Second item we look at, and the third item we think are going to be in play this year. Housing starts and vehicle sales. Housing starts kind of plateaued, the black line here, they kind of plateaued and went sideways as home builders had trouble with the 3 L's last year, land, labor, and lumber last year. And we suspect they're going to start to catch up this year, although all real estate markets are local. Autos, the auto production in the US is way down. You know that story there. Semiconductors. Literally, there's 18 days of supply of autos on dealers' lots right now. Going back to the 1970s, we've never seen anything that low by half. So autos and housing are 2 areas we see as strength in the economy as they both come back and rebound from various challenges during 2021. The 2 at the bottom, they're harder to read because of the scale of this. Exports, we'll get a report on this week. Exports have been moving back up since the great lockdown last year. If you're in that business, hopefully you're seeing the same thing, although the dollar's moving against you a little bit now because the dollar's higher. Now, construction, our industry primarily, you know the story there. Nationally, we're seeing more activity residential versus non-residential, what Adam just talked about a little bit. And again, that's local to each market. We're very fortunate we have the industrial base we do here in Chicagoland. So these are 5 building blocks. Think of your industry, think of your customers. We keep track of these. This chart set goes back to 2002. And by the way, you'll see a series of charts like this. Notice the long blue columns. Those are recessions, okay? Inflation. Next week, we're going to get some reports on inflation. For the first time since really last summer, the expectation is that both the green line, producer prices, and the black line, consumer prices, start to roll over. That's going to be big for markets next week. Remember, markets got riled up yesterday because they found out yesterday at 2 o'clock what the rest of the FOMC members thought, not just Chair Powell, and they were more hawkish. That's what turned markets yesterday. Next week, we're going to get updates on these. Are we going to go back to the 1970s levels of inflation that some of us remember? That's on the left-hand side of this chart. This chart goes back 50 years. Probably not. But are we going to go back to levels of low inflation we saw really for the previous 10 years prior to the great lockdown last year? Probably not either. If inflation is something on your mind, the way we're explaining it is kind of 4 words. 2 words on the left, technology and globalization. Those literally work to keep inflation low, 1% to 2% range, the last 10 years. Technology and globalization. They're not going away. But now on the right are two issues that have come up since really the lockdown: supply chains and commodities. Those are both higher. Those are both in different states. They're kind of related to each other. They're in different states of recovery, I should say. And it's being impacted really by, in our view, the pace of the virus. Because most supply chains, most commodities start somewhere in emerging markets. And emerging markets are having a tough time controlling the virus. So getting the virus tamped down in emerging markets, that's what's going to be helpful to inflation in our view, to get supply chains normalized, get commodity prices come down a little bit. Third area, this is a good looking chart, isn't it, by the way? Lots of action on this chart. Interest rates. And by the way, in each of these charts, you'll notice a black box. Those are consensus estimates for each of these items that we're talking about for this year. This chart is about the Fed and interest rates. This goes back to the early 1990s. We're probably going to start our fifth Fed tightening round in the last 30 years this year. So we're going to get our fifth round of Fed tightening. Doesn't mean the world's going to stop. Doesn't mean our businesses are going to stop. Doesn't mean markets are going to stop. In general, though, what we suspect is what the Fed needs to have happen, and they got a good start on yesterday, they need the 10% Treasury yield to go to 2% before they can start tightening, raising rates. They need a 2% 10-year so they don't invert the yield curve. Now, I'm using some jargon, I apologize. But in the end, we suspect that a 10-year Treasury is going to move quickly up to 2% by mid-year because the Fed needs it there. Then potentially they raise rates, their short-term rates, a couple of times, second half of the year. We're not with the street on this one. We don't see them starting in March. We don't see them raising 3 times. We see more like 2 times. However, it's all predicated on the path of the virus. We know that as well. So this is the 10-year, 2-year, and Fed funds rate going back 30 years as mentioned. If interest rates are really important to you and your business, your shop, what you watch is the green line, the 2-year. The 2-year yield is the market's vote where they think the Fed funds rate should be 6 to 12 months from now. Now, yields have jumped since we turned this chart in. This morning, a 2-year is at 86 basis points, not 73 as noted here. So the market's thinking 3 Fed rate hikes. We think they got a little bit ahead of themselves, just like they did in 2013, 2014, where the green line went way up above Fed funds. Sorry about that. That was the most jargony slide for you. This one's going to be a big impact on all of us. It already is. This year, labor market. This is the blue line here is calculated the number of job openings in the country as per something called a JOLT survey. Now we got an update on this week. Instead of 11 million, it's now 10 million and change, 10.6 million. Lots of jobs, lots of mismatch in job skills and what's open. What's of interest is the red line and the green line. The red line is the calculated unemployed people in the country. 6 million, 6.8 million. Now this series only goes back to 2000. But we've never seen anything like this. In 2019, blue line was ahead of red line. That means there were more people, there were more help wanted ads than unemployed people. This time, it's even more stretched far apart. That's how tight the labor market is in the country. Oh, and at the same time, the green line, the Great Resignation. People are quitting. So to sum this up at the top, we put in green up there. We are not going to end wearing our talent management hats anytime soon. All of us now wear talent management hats. Some of us maybe 15% of the day, some of us maybe 50% of the day, where we're trying to retain, recruit, and train employees. That's how tight labor markets are. Unfortunately, they're just not going to reverse. And each one of us in our companies are going to have to get creative. We're already doing it. You're already doing it in how we attract, retain, and train employees. This quit rate is something new, very new. It's especially hitting the trades, which hits a lot of us. So labor trends, tight. That's the best description we have for you. That's the most technical description we have for you. Number 5 here, you might find this one of interest. This in our business we call the wall of cash. This wall of cash that's on the sidelines. There are 4 different components to this. The blue line there, the dark blue line, there is literally $18 trillion sitting in banks earning 0. And oh, by the way, prior to the lockdown 2 years ago, there was 13.5 trillion. Now it's up to 18. Then the red line here, corporations are filled with cash. We're all over cashed right now. Corporations are filled with cash. The red line, public companies, S&P 1500, not just 500, 1500, over $2 trillion of cash on their balance sheets. And oh, by the way, what are they doing with it? Last year was a record year for global merger and acquisition activity, over 5 trillion. They're out buying stuff. We would suggest the same to you. What we're going to be suggesting to our customers, we start a series of economic breakfasts next week for our firm. And what we see is good balance sheets buying bad. We see a lot of business expansion going on. The 2 at the bottom here, you don't hear about as much, but this is cash and money market funds. The green line here, there's approaching $5 trillion in money market funds, earning 0. Cash has a high cost to it right now. One of the highest we've seen because we earn 0, the inflation rate's running 6, and everything keeps going up in price. So if you're holding a lot of cash right now, make sure you have a reason that you're holding that cash and that you're probably going to use that cash in the next 6 to 12 months. If you're not, give that cash the ability to try as best it can to cover this inflation rate. That's the job. Keep purchasing power. The neon blue line there, oh, by the way, banks have so much cash that they have deposits on reserve with the Fed. That's the blue line, neon blue line, over 4 trillion. Now, practically what this wall of cash means, this is why we never saw a 5% correction in the stock market last year. Every time stocks pull back, some of this cash comes out. We'll probably see the same thing this week. When I sat down, Dow futures were up. There is a huge wall of cash looking for investment opportunities right now. Just point it out to you. And think about your own circumstance in the room. In summary, economy. You're going to hear 2 words about the economy this year, we suspect: normalization and substitution. Substitution is because of the shortage of things, supply chains, and the cost of things, think grocery store. Inflation, we do see it slowing. Next week will be a big week for inflation. Markets will react. Third one, monetary policy. We're not as hawkish as the markets are right now. 2 Fed rate increases this year, not 3. But it depends on the path of the virus. Number 4, interest rates. We see a 10-year at 2%, but it probably doesn't get much above there. European rates are still negative. Probably can't get much above there. The number 5 labor market, it's tight. You know that. That's the best way we can describe it. It's not going to loosen. You okay so far? Now, in honor of our negotiations to get a casino, we put the big 6 up there. So I'm a craps player in Las Vegas. Those of you that play craps will get that. Those of you that don't will say, what's this guy talking about? So here are 6 charts about our local market. Again, this is to give you kind of an outsider view looking in, okay? So first up, our economy in general. When we look at Chicagoland, this is our metro area. The green line up at the top, we're a $700 billion economy. It's kind of unfair to use this because this is the down year in 2021. 2020. We don't have 2021 numbers yet. As you know, our economy picked up last year, just like the national economy. So we're a $700 billion economy. We're our own country. You know that. The employment numbers, we're recovering. We're not where we were pre-pandemic, but neither is the country. So we are following the trend of the country. We have 4.5 million workers are employed in Chicagoland, not where we were. We were at 4.8 trillion prior to the pandemic. We're pushing back up just like the country is. The next one, median home prices finally are recovering. That's been a source of angst for us in Chicagoland. We'll show you another chart of this in a minute. Neon blue line. Then our unemployment rate, it's coming down as employment goes up. We're with the national numbers. These are 4 things, by the way, we look at when we look at regional economies, local economies. And our trend fits the nation. The one to watch, this is very busy, I understand, but we've been pointing this out for a couple years. You see our employment number rising, both in the city, that's the red line, and in the metro area, that's the blue line. That's the chart on the left. What's not rising is the right-hand side, the labor force. We have a lot of folks retiring and we're not replacing them. So look how our labor force grew in the 90s in that chart. But now it's rolled over in the city and in the MSA, Chicagoland. This is something that catches our attention. What's this mean? This means our pool of customers, our pool of employees is shrinking. And it's very odd to us, given the region, given the quality of life, et cetera, of Chicagoland. But it's something to point out. It's a challenge for us, labor market, or labor force, I should say. We don't see this in a lot of countries, or excuse me, a lot of cities around the Great Lakes. We're unusual here with labor force rolling over this hard. This is something you probably haven't seen, but it was very noticeable to us. Now, the first thing to remember, this is a report about our state of Illinois. However, if you look at the top, we're 81% of the economic output of the state. CNBC does a survey, top states for business. The reason we like this survey is it has 10 components to it. It started in 2007. Last year there wasn't one, or 2020 there wasn't one, I should say. But look where we are. The lower the number, the better. We're number 15 now for top states for business. When this started in 2007, we were number 39. Policy-wise, politically-wise, we're making moves to make our state more attractive for business. We think that's important. That's a very good move. This is a great trend. In this report, it's just one report, but we like it because it has 10 components to it. And you can look this up online. Next one up, this is home prices. It took us a while, this is a little bit beyond the conversation, but excuse me, it took us a while to get our home price index, our condo price index back to where they were. This comes from an independent group, Standard & Poor Case-Shiller Home Price Index. But we just wanted to point out to you, we're finally back where we were in 2006, 2007, good news. because we'd been lagging a lot of the country, getting our home prices back. This is good news. Good news for homeowners, condo owners. This one's tough to read, but the point here is something Adam talked about. We do have a distinct advantage in commercial real estate. Our costs are much lower than the coasts. You know that. Our costs are much lower than the coasts. That's a competitive advantage for us in commercial real estate across the board, pretty much. Last one, just give you a snapshot. Adam talked about this a little bit too. This is office, people returning to the office. I don't think they got Omicron in Texas, it doesn't look like, but we're about in the middle of the pack. People return to the office. By the way, this number was as of December 22nd. The chart on the right-hand side just gives the highest, lowest average of these 10 markets, top 10 markets in the country. So if you're in the office business, we're about in the middle of the pack. People coming back to work. What we would say, outsider looking in, out of these 6 areas, the only red X we get is labor force. It's unusual. Most labor forces are increasing. Ours is not. We attribute most of that to retirements, aging workforce that we're not replacing. We get 2 green stars for our business attractiveness. That's that CNBC survey. And then our costs, commercial real estate trends. We are not a low cost, but a value cost provider in commercial real estate, we would say. Last section, you okay? You guys want me to keep going till about 11:30, 11? Thought you might like this chart. This is the history of the Dow Jones Industrial Average. See the double zeros in the lower left? That's 1900. This is the path of the Dow Jones Industrial Average going back to its beginning in 1896. Now, we did this about 10 years ago, and it was very eye-opening to us. Now it's almost getting scary to us. Here's the story. The US stock market moves in a very distinct stair-step pattern. Goes up, sideways, up, sideways. You see some faint yellow arrows in there. Went sideways for a long period through the Depression. Starting in 1942, went up noticeably, got stuck in the 60s and 70s, inflation. Got unstuck in the early 80s, went up into 2007, 2008, got stuck again, got unstuck in 2013. Now, if you can answer this question, you get the podium. When it goes up, look at the left. If you were reading a newspaper of the day in the 1920s, the Dow Jones Industrial Average had a closing number of around 10. Or excuse me, 100. I should put my glasses back on. If you looked at that same newspaper in the 70s, had a closing number of about 1,000. Then, when we came into the turn of the century, had a closing level of 10,000. Today, it's roughly 35,000. It goes up tenfold for about 20 years. Then it stops. Why it does that, we don't know. But it's very noticeable to us. If this is right, and by the way, in the economic markets business, history doesn't repeat, but it rhymes a lot. If this is right, we still have a ways to go in the stock market. Stock market's only gone up 3.6 times based on that 10,000 number. We still have a ways to go to get to 10 times. We'll go through recessions, et cetera. It doesn't go in a straight line, but this is very noticeable to us. There's still time for stocks to rise. Do we know if this will happen? No, but history suggests very sharply that this pattern is in place. It's almost scary to us. Here's interest rates. Now, this only goes back to 1950. Many of you lived through the rise in interest rates. They peaked in the early 1980s. Pretty much my entire career, I came in this business in 1989. My entire career has been interest rates down. So is yours. Interest rates down. Some point they're going to go back up. The point of showing you this is this neon blue line here. Compared to the inflation rate, bonds are not a good deal right now. This is mostly around your portfolios. We have to skew towards real estate, towards stocks to overcome the inflation rate. We just can't get it out of the bond market because yields are so low. Well, that's great for borrowers. It's not very good for investors or savers. So this neon blue line being so negative, we've never seen anything like this except two other times, as you can see here in the middle, going back to the 1970s, early 1980s. And our business is called negative real yields. A yield on a 10-year treasury versus the inflation rate. So to put it short, in our business, we're bond light because these yields are so low compared to inflation. And as long as we see the economy moving forward, which we do, we don't see a recession, we're probably going to stay bond light until it's a better deal to buy a bond in relation to the inflation rate. So this year is all about, will inflation come back down? And how will the Fed react to it? All right. And it all follows the path of the virus. When we did this chart set for you, Omicron really hadn't come up yet. So we hope you and your family are safe. On behalf of all my colleagues at Huntington, Ernie, thanks for having us today. And hope we didn't keep you too far behind. I apologize. We tried to get going here. So thank you. Appreciate it. How I get out of here, I have no idea.
Any questions?
Yeah, if we do you have time? We'll do questions. Yeah.
How concerned should we be about the federal spending that has already taken place to combat COVID and the proposed federal spending in the Biden program?
So we're up to $29 trillion in debt. With the pandemic 2 years ago and the fiscal support, that means government spending behind it, this is a global event of debt levels of governments going up. We're not the only ones doing it. We're not the leader in government debt. Japan is the leader in government debt. Then comes some countries in Italy, or excuse me, in Italy. Then comes some countries in Europe. So what we suspect is that the spending slows down. This is a political year. We each have a view of that. Spending starts to subside. We need growth now. It's all about growth now. Can you grow into what you spend? We do the same thing in our personal lives when we come out of college. So government debt levels are elevated. Ours is especially elevated on the other side of this. We were more proactive in spending against the pandemic than other countries were, which, by the way, is bringing us out first. From a debt perspective, give you a couple of observations. So what we worry about is high debt, low activity. Think about coming out of college, coming out of school, and you had high debt. You couldn't go out on Saturday night, right? You'd stay home. So lower activity is what we always worry about with higher debt. The US, we're in a little bit of a unique position. We are very fortunate in the US to have the US dollar as the world's reserve currency. Because when things happen in financial markets, they happen to us last. Probably the first time you're going to see debt talked about in relation to government is in Europe. We already went through 3 bouts of that over the last 15 years when we all learned more about the country of Greece and its economy than we probably wanted to. So government debt is going to be an issue because it slows things down. You got to grow your way out of it or inflate your way out of it. We hope growth is the choice. We suspect spending slows. We don't know that. We know this is going to be a highly charged political year. But we do know something that's very important to us, the dollar. The dollar is very important. We're very lucky not only to have Pfizer and Moderna, but to have dollar as the world's reserve currency. Things happen last to us. The next debt eruption, government debt eruption, is probably going to start in Europe. It's not saying it goes away, just giving you kind of a path. All right.
Very good. Thanks again, John.
Thank you. Thanks, everybody. Have a great meeting.